And as Reynolds mentioned in the intro, this will impact different countries in different ways, and this could be a whole other presentation on who are the winners and losers in these low oil price scenarios. I could put Alberta's budget in here, but I won't do that. We can see many countries here that have oil prices assumptions in their budgets that are much higher than where the current price is. And this will create big challenges. Probably Venezuela is the hardest hit of all these countries, with just a few $1 billion in exchange reserves left and very few people willing to lend the money at this point. We expect more civil unrest there, which could also support oil prices. What about spending? Right, so this chart shows, I mentioned the need to subdue the enemy. Right, the Saudis want to see their competitors, the super majors, the big global E&P companies, spend less. Right, on the left side of the chart is the 1986 shock. What happened to super major spending during 1986? They ended up cutting spending by 30%. Then in 1999, same, they got to about 30% cuts. Now, so far, what we've seen in 2015, we're only still about 15 or 20%. So unfortunately, there's more cutting to come this year. And I think that the Saudis probably want to see another round of industry capex cuts at the end of 2015, and only then in 2016 will they return their focus to getting prices back up a little bit higher. If the Saudis start to manage prices higher now, a lot of the spending will just ratchet right back up again, and they'll be back to the same situation with growing competition from North American supply and a growing surplus in the market. What's interesting here is that if you look at US-Canada, right, this is not a decline in production, this is a slowdown in the rate of growth. Right, so yes, US will grow less than expected, Canada will grow less than expected, but still growing. Right, so again, in 2015 oil prices, thinking about $100 barrels, it's going to be hard to do that when the US and Canada are still growing. It takes time to slow down this type of investment, especially here in oil sands. The US, it happens a little bit faster, but still it's more of a 2016 story than anything else. All of non-OPEC together, down a couple 100,000 barrels, not a huge deal. Do the Saudis really understand how the US shale plays work? Right? Are they really betting on more of a total price war scenario where maybe they keep prices below 50 for 3 or 4 years? Right? In that case, you probably would see not just a slowdown in growth in the US, but a real reversal. Right back to maybe 6.5, 7 million barrels a day, because some of those shale oil fields in the US would be uneconomic, and obviously the same here in oil sands as well. But as of right now, for this year, you're again looking at basically a flattening or a slowdown in growth in the US, even with all the drop in the rig count that we've seen. So if the Saudis understand that, it probably suggests that they're not going to try to pursue a longer-term lower price strategy, which would probably be too expensive for them anyway.